But we're going to start out with the economy, news in the economy. And the main thing that I really want to talk about is, and the main verse that I like pulled out to kind of like relate to this news in the economy is Luke 14:28-30. Is there anyone among you planning to build a new house doesn't first sit down and figure out the cost so you'll know if you can complete it? If you only get the foundation laid and then run out of money, you're going to look pretty foolish. Everyone passing by will poke fun at you. He started something he couldn't finish. And the reason I want to talk about this is because there's been a push in the market, and there's been kind of some different concerns, not necessarily a market downturn and not necessarily any type of fears of like the economy crashing or something like that. But that's the way people make it sound when they talk about the economy, because everything is fear driven. But there is a concern, however, when it comes to private credit, because private credit companies or CDBs are lending out massive amounts of money to build AI data centers. And actually, a lot of them are being built. And I'm going to share a little bit about why. Yun Li, in an update by CNBC, it says 784 institutional clients shows investors increasingly worried about vulnerabilities on private credits. And there's a fear that this private credit is ballooning too much, because as we'll compare the percentile of different companies and different borrowers defaulting on the loans that they've taken out through private credit companies is massive compared to like 2008 during the 2008 financial crisis and stuff. But we're going to compare later why that isn't as concerning, even though it is a bigger percentile overall borrowers and overall businesses borrowing, because at the end of the day, the economy back in 2008 was a lot smaller. And the reason why there is this huge fear revolving like the future of AI and the future of AI data centers is because this quote unquote bearish market, because a lot of people have this opinion that there's a bearish market currently, even though there's still a lot of bullish opportunities in terms of like the 7 top countries, the 7 top companies constantly are trading trillions of dollars between each other. And those are the magnificent, the Mag 7. So the Mag 7 makes up Alphabet, Amazon, Apple, Meta, any type of Meta product like, Instagram, all of those companies, because they're all owned by Meta, Microsoft, NVIDIA, and Tesla. And basically the biggest thing is that those 7 companies are constantly trading back and forth trillions of dollars, kind of like lending each other like billions of dollars at a time. And it's basically just like the same money used over and over in a constant cycle. And it's kind of creating this AI bubble. Now, the thing is that people are worried, oh, is it going to be like the .com bubble when the AI bubble bursts? And the real answer is probably not, at least the people that I've talked to, like former financial advisors and stuff like that, because the biggest thing is that what you're really investing in is not only the real estate of like data centers and stuff like that, but you're also investing into something that will be continuing to grow no matter what. So just as long as you're investing into something real when it comes to AI, if you're like an institutional investor or just an investor in general, you are going to not be hurt as much as compared to maybe people who are just investing into stocks per se. But that's if an AI bubble bursts, like the .com bubble. With the Iran war in the foreground, or at least the ceasefire of the Iran war in the foreground, that's why I think a lot of people and a lot of institutional investors were concerned about an AI bubble popping because of all these different things. But as I said, why be concerned about it if you're actually invested into the actual assets of AI and actually like maybe even owning different companies that are developing AI? But not only that, but the reason why all of these different companies and borrowers are defaulting on the loans that they've taken out from CDBs like Blue Owl and other companies similar to Blue Owl. The biggest thing is that you got to remember that there's a lot of supply chain issues when it comes to technology and when it comes to the materials used to build like these data centers and stuff. Brian Peters in his article, Perspective on Risk, March 15th, 2026, on private credit, the value of gating, and as usual, Jamie Dimon controls the flow of credit. Sorry, that was the title. That was a really long title, but that's just the title. Private credit's reported default rates have been low. However, Brian continues to discuss in the article about how these different companies like Blue Owl are actually facing a lot of different investors trying to redeem their investments. So for instance, he says, in its inaugural private retail debt fund, OBDC 2, Blue Owl said investors will no longer be able to redeem their investments in quarterly intervals and will instead get capital back through episodic payments as it sells down assets in coming quarters and years. And granted, the one former financial advisor I was talking to about this, he was like, at the end of the day, if you're investing into any type of loans that you're trying to make interest on in the future, you know what you're investing in. So it's a question as to why all of these investors are trying to redeem it when all of these companies like Blue Owl are trying to gate all of the investments that these people are trying to take out now, even though they've already, agreed to the terms and all of that of the loan and the covenant of the loans. But the weird part is that even though that there is a concern about all of these investors trying to pull out their money or redeem their money from the CDB companies, there is a concern, however, that this can actually balloon into effective like private credit, kind of like the dot-com bubble instead. Maybe it's not the AI bubble. Maybe it's not the AI bubble, but maybe it's the credit bubble. Granted, I think that's a lot of fear talking. I don't think that that's actually like a legit thing, and I'm going to get to why I think that and why other people think that. But long story short, to mitigate this runaway train, quote unquote, I don't think it's a runaway train because, granted, all these investors can't even get their money out, even though they're trying to redeem it. The reason they are is because the investors believe it's like all these loans are illiquid, meaning like they don't think they're going to get all of their investments to the same degree in terms of like the amount of time it takes to make up for the investments through repayments and interest rates. And most of that fear is honestly driven by the debt and by the price tag of all these data centers, as I've said. But it's not just Blue Owl. It's like one of the biggest companies that were headlining this week in terms of like gating or capping investors from redeeming their investments. But as Ranganathan states, Blue Owl Capital, OWLN, was the latest BDC to report it received a historic level redemption request this week and was limiting withdrawals, which it is allowed to do because, I mean, granted, the covenants of the loans and all the rules that are attached to it, like these investors know what they're investing in. They don't need to get their money back because it's illiquid. Like they're going to make their money back either way. And all these investors that are trying to redeem their money, granted, I'm going to get to this too. Like some of these investors might be wanting to redeem their investments because some of these data centers, as I said, are actually closing, like the plans to build them and stuff like that. Because a lot of these data centers that they were planning to build, like half of them, they canceled because they realized we not only have supply chain issues, but we also have a lot of issues with trying to repay these loans and stuff like that. But long story short, other big players such as Ares Management and Apollo Global, Blackstone, and private credit arms of banks such as Morgan Stanley, JP Morgan, Goldman Sachs have also capped redemptions. So it's not just Blue Owl, even though Blue Owl was one of the big names in the news. Granted, it's probably the most amount of investors trying to redeem their money through like out of Blue Owl and whatever. It's everyone, basically. Everyone that tries to lend private credit. The biggest thing I want to emphasize, and people are like, Grant, you're not an economist. Like, why am I listening to you? And you're probably not because, this is really dry and boring. But I thought it was interesting and important to talk about because I'm trying to, introduce an economic segment into my podcast, granted. But not only that, but I do think it's important to understand why AI has basically become such a huge thing in our economy and such a huge thing, not only in the economy, but in our culture too, because like everyone and their mother that's an investor, everyone's invested in AI. Everyone's invested in NVIDIA. Why? Because their returns are incredible. If you were like, for instance, let's just do the math. So for instance, if you would have invested in NVIDIA just 6 years ago, you would have had an 1,000 to 1,200% return on the investment you originally made back in 2020. And that's even without adding extra money into NVIDIA and stuff like that. But granted, I'm not saying go buy NVIDIA. I'm just sharing an example of like why AI is such an important thing in the economy, because it has ballooned into this huge thing where everyone that's an investor has been invested in AI in some way, shape, or form. But this one thing that I want to read you is the fact that even though people are afraid, people aren't afraid, but people are fearful at the very least or concerned about the direction the AI bubble is forming, quote unquote. But before I continue, as I said, I'm not an economist, but this is what ChatGPT helped me kind of come up with, and it's kind of relating why why the defaulted loans in the private credit market aren't as big as a deal as it seems. Because, like, for instance, back in 2008, right? 2007, 2008. So in 2007, the default rate in 2007 on private credit was 0.9%. And in 2008, during the financial crisis of 2008, it was 3.5 to 4.5%, which is, pretty crazy because the economy was a lot smaller then. And in 2025, the default credit rate was at 9.2%. That's a huge number compared to 4.5%. But the thing you got to remember is this. The economy back in 2008 was a lot smaller, so it was a bigger deal. And plus, the issue in 2008 wasn't even about private credit. It was about the banks. So, that's the biggest thing. But ChatGPT kind of helped me, compare, contrast 2008 and 2025. And so one of the biggest things is that this is the thing you got to remember. The default rate is small, 0.9% versus 4%. And then massive compared to the multi-trillion dollar economy of today is 9.2% reported by Fitch. And then the system impact was immediate and explosive because of the blank-driven contagion. And then today, potentially slower, spread out, but broader wealth exposure. Because why? Because all these different investments that are in private credit, all of the interest, all of the, like for instance, whenever these private companies make money off the loans they give to other businesses, like to build AI data centers or whatever it might be, not just AI data centers, these institutional investor portfolios include things like sovereign wealth funds, endowments, pension funds, and insurance companies. And for instance, back in 2008, another difference. Back in 2008, the banking exposure was very high. Today, lower direct exposure, risk dispersed across non-bank institutions. Transparency was low back in 2008. And today, still low. But it's private markets, that's why. And then the institutional exposure was limited direct exposure. And today, it's high exposure with pensions, insurers, endowments, as I said, and major allocations. And the risk transmissions went from banks to the financial system into the economy. So it affected everything back in 2008. Today, it affects private credit to institutions to retirement savings and long-term capital. So granted, it might affect retirement savings. It might affect different pension funds and stuff like that. But the important things is that it's a very low risk. And I'll tell you why in a second. And then finally, the liquidity risk is the bank liquidity crisis. But today, the liquidity crisis isn't in the banks. It's just in the private funds, or so they say. People like to actually bring in a real, expert. Because I'm not an expert. I was 7 when the 2008, crisis happened. Experts like Jamie Dimon have said, in an article by Payments, said, Dimon said private credit probably isn't a systemic risk in the grand scheme of things, noting that its nearly $2 trillion size is dwarfed by the market size of investment grade and bonds, residential mortgages and securities, both of which are $13 trillion. So the size of the potential bursting of defaulting loans and all of these different things in credit and private credit, kind of ballooning different things and making things ill proportionate to each other and other institutional investors, kind of a low chance. And even if they do, it's not going to affect it as much compared to in 2008. And the editorial board of the Wall Street Journal adds, quoting Jamie Dimon too, I do believe that when we have a credit cycle, which will happen one day, losses on all leveraged lending in general will be higher than expected relative to the environment. And Mr. Dimon wrote his annual letter, as Mr. Dimon wrote in his annual letter to shareholders. This is because credit standards have been modestly weakening pretty much across the board. So basically, all these different companies, they never learned their lesson because they never learned the consequences of their actions, because the government bails people out. The government bails companies out whenever they go bankrupt or whatever. And so there's never any standards for whenever all these different companies, CDBs, lend out millions and millions of dollars of money to all these different private companies and stuff. Basically, the investors are wondering now, because of all this, long story short, is the fact of, are all of these assets created by AI worth it still? And quoting Srivastava and Binney explaining, Moody's Moody's also flagged emerging risks from artificial intelligence to BDCs, large exposure to software companies, which account for roughly a quarter of portfolios. Though executives dismissed those concerns as overblown, investors remain on edge. Asset quality remains stable for now, but the agency expects credit performance to weaken as technological disruption unfolds. And the one thing, before we get to the technical disruptions, right, the one thing I want to point out is the fact that they talk about that roughly a quarter of the portfolios account for all these different software companies that some of them, as I said, some of these borrowers are defaulting on the loans and stuff like that. So maybe that's the reason why some people are concerned, because it does make up 25% of all those different portfolios that are institutional investors into these different loans that these companies are loaning out to the companies building AI data centers and more. You know, kind of makes sense. But at the same time, let's talk about the technological disruptions, because I really believe truly that this is one of the main primary things, that reason why investors are trying to redeem their money from the loans that they invested in through all these CDBs. As they said, the asset quality is in high demand, which is true. I think the one financial advisor I talked to, actually, we did an episode together. So click here or here, wherever it pops up. If you want to go watch that, that was a good conversation about biblically responsible investing. We explained what that is. It was a great conversation with Mark. But I was talking to him, and he was saying how, as I said at the very beginning of this, like, very long and winded conversation and explanation, is the fact that if you are really invested into actual assets, like maybe like the building the AI data center has or rents out or whatever it might be, right? You are still making money even if the AI bubble happens. Like, it doesn't matter. Like, if you are actually invested into actual companies that are still developing AI tools, whatever it might be, but especially data centers, if you own the building of the data center or the companies renting out the data center, you're still making money. So like, those assets are never going to go away if the AI bubble happens or not. You know, even if some investors, like half of the investors leave, you're still making money off of the real investments you made off of AI. At the same time, all of these fears, I believe, the main reason isn't because of liquid loans and stuff like that. It's because of the physical systemic problems facing all this stuff. And so one of the main things that I really want to read from Shilov was, despite the unprecedented level of an AI investment in AI infrastructure, Amazon, Alphabet, Meta, and Microsoft are expected to spend more than $650 billion in 2026 to expand AI capacity. Close to half of the planned U.S. data centers builds this year are projected to be delayed or canceled, according to Bloomberg. One major reason behind these setbacks is the availability of key electrical components, such as transformers, switchgear, and batteries that are used both at data center sites and outside of them. As AI companies must expand grid infrastructure to supply enough power to data centers. Meanwhile, grid infrastructure is also stressed by electric vehicles and electrified heating systems. And Wilkins also adds, things get even dodgier in the coming years, with the vast majority of data centers planned for launch between 2028 and 2032. So like, some of these data centers haven't even been built, or even the foundation hasn't been built. That's why I shared that verse that Jesus talked about, because it's about, like, biblically, you should actually count the cost of your investment, and whether or not you have the money, or whether or not you have the investment to be able to fund all of the plans you have in the future. That's why, God calls us to be wise stewards of our money. But the biggest thing is, there are further 37 gigawatts of planned infrastructure which haven't received a firm completion date, only 4.5 which have actually begun work. So 4.5 out of 37 gigawatts. Whether you can understand what gigawatts are or not, that's a lot. No, actually, let's do the comparison. So to kind of wrap your head around what a gigawatt is, because I looked it up, ChatGPT helped me here. Even though I hate AI partially, I'm glad that we have it for quick statistics and quick comparisons. So if 1 gigawatt can power up to 750,000 to 1 million homes, which is insane. So basically, we need the infrastructure for all these future data centers. Some of them are being canceled anyway. But in order to actually make all of these different things, in order to actually make all of these data centers, we would need the equivalent of power used to power 37 million homes. And we only were able to actually, or 4.5. So basically the equivalent of 4.5 million homes being powered have only begun to like start the work of like creating the infrastructure to be able to generate that power. So it's like that's insane. So 4 million out of 37 million is a huge number. And that just kind of shows you the physical constraints on the old infrastructure of this country. Another restriction, as I said, as Wilkins said too, is the fact that all of these different electrical parts are also backlog. Due to high demand, lead times for high-powered transformers have expanded dramatically in the U.S. Delivery typically took 24 to 30 months before 2020. This is before 2020, 6 years ago. So almost 3 years. That's how far the backlog was for all these projects. But waiting periods can stretch for as long as 5 years today, according to Sightline Climate cited by Bloomberg. For AI data centers, this is a catastrophe as their development cycles are under 18 months. So so think about this. Your 18-month project turned into like a 7-year project. As a result, Canada, Mexico, and South Korea became the biggest suppliers of high-power transformers for AI data centers to AI data centers. At the same time, imports of high-power transformers from China surged from fewer than 1,500 units in 2022 to more than 8,000 units in 2025 through October, according to Wood Mackenzie data cited by Bloomberg. That was the article by Wilkins. By the way, all this data, all of these different quotes that I'm mentioning and stuff like that to kind of like, help this conversation and help this like, my argument. I don't really have an argument, but I'm just kind of, talking about this because it's something that I care about for particular reason. Some of you may be like, this is incredibly boring. What are you talking about? But it's all of my notes regarding this and regarding AI and regarding these data centers and private credit and stuff will be in the description. If you try to run it through Grammarly, it will say that I plagiarized. It is just notes. It is not a real essay. Okay. Just want to get that out of the way.